I asked ChatGPT and Deepseek for the 5 most undervalued stocks in the market today, which we'll analyze, and whoever finds the most undervalued stocks wins. Some of these stocks are truly hidden gems, so watch all the way until the end. First, we will ask ChatGPT and Deepseek for undervalued stocks. The first stock from ChatGPT is Intel, INTC. We will evaluate the company based on growth potential and valuations, both on a scale of 1 to 10. The stock with the highest score wins. Starting with growth potential, Intel designs, manufactures, and sells computers products worldwide. The demand is high, but the competition is tough, with major players like AMD and Nvidia. However, Intel is a turnaround play, as it is heavily investing in improvements to its profitability and competitiveness. The company is cutting costs and simplifying operations while investing in AI and custom chips. It's also making strategic acquisitions to expand its chip manufacturing, aiming to boost margins and stay competitive. Our rated is 7 out of 10 for growth potential due to the growing industry despite the tough competition. In terms of numbers, Intel has a PE ratio of negative 4.4 and a price to free cash flow ratio of negative 5.3, which aren't the best, as it shows the business isn't profitable. However, there's a story behind it. As mentioned, the company is investing heavily in chip manufacturing with two 20 billion acquisitions in 2021 and 2022, which are still impacting the business. Intel is a long-term play. Despite negative free cash flow margins and profit margins, it has a gross margin of 35%. Overall, I'll rate the numbers a 4 out of 10, giving Intel an overall score of 5.5 out of 10, which is decent. DeepSeek's first pick is Enact, ACT, a private mortgage insurance company in the US. This is a medium to low growth industry, as Enact has maintained stable free cash flow since 2020, but with solid double digit free cash flow growth from 2022 to 2023 and trading 12 months. The company's strong risk and expense management have boosted its bottom line. Enact also returns capital to shareholders through buybacks and dividends, repurchasing about 6% of its shares over 3 years. Enact is well positioned for future growth, driven by a strong financial foundation, strategic capital management, so capital allocation, and commitment to delivering value to stakeholders. Despite this, I rate its growth potential a 5.5 out of 10. Next numbers are strong, with a 5-year average return on investment capital of 12%, a gross margin of 78%, a profit margin of 57%, and a free cash flow margin of 54%, all well above sector medians. It has also a low price earnings ratio of 7.7 and a price to free cash flow ratio of 7, making it very cheap. I'd rate the numbers a 8 out of 10, which brings ACT's total rating up to 6.75 out of 10, giving DeepSeek the first win out of the 5 stocks. And these are some medium ratings, but it's going to get much better. The second stock for ChatGPT is Target, TGT, a general merchandise retailer in the US. Target's growth lies in gaining more revenue from either new customers or existing ones. The company is already large and has positioned itself as a major player in the retail space. What sets Target apart is its Circle loyalty program, which have boosted personalized offers and increased store traffic by 3%. Target also reduced product costs, contributing to a rise in comparable sales in Q2 2024. Additionally, the growth of same day service like curbside pickup and same day delivery now makes up over two-thirds of digital sales, improving convenience and satisfaction for customers. Target also plans to open 300 new stores in the next decade to expand its reach with convenient shopping experiences and delivery services. Target stands out from competitors with its pricing power, brand image, and product assortment. However, the retail space is competitive, so I'd rate Target a 5 out of 10 when it comes to growth. In terms of numbers, Target has a PE ratio of 14 and a price to free cash flow ratio of 14, which I consider cheap for its current price. The company has a gross margin of 30%, a profit margin of 4%, and a free cash flow margin of 4.2%, which are modest but solid in the retail space. Target also has a 5-year return on investment capital of 14%, which is impressive. Based on the numbers, I'd rate Target an 8 out of 10, bringing its total rating to 6.5 out of 10. For DeepSeek's second pick, it should have been Intel, but we'll skip that one and move over to the third, Google. At the time of recording, Google stock had dropped by nearly 10%. Alphabet Inc. offers a wide range of products across the US, Europe, the Middle East, Africa, Asia Pacific, Canada, and Latin America. It operates through Google Services, Google Cloud, and other bid segments. Google is a giant tech company with large moats in its industries. For example, it controls 90% of the search engine space, including Google and YouTube, making it hard for competitors to penetrate. Google is also focusing on profitable, growing industries like the cloud business, which recently started earning money and growing with double digit growth year over year. However, Google's size could make it hard to maintain this growth, so I'd rate its growth potential a 7 out of 10. The numbers for Google look solid, with a PE ratio of 25. While this may seem expensive, you're paying for a high quality company with a large moat. Google has a price to free cash flow ratio of 32 due to heavy investments, a gross margin of 58%, a profit margin of 28%, and a free cash flow margin of 20.8%, all solid numbers. Google has a 5-year average return on investment capital of 30%, which is impressive. Overall, I'd rate Google 8 out of 10 on numbers, giving it a total rating of 7.5 out of 10, which beats ChatGPT's target rating of 6.5 out of 10. Deepseek takes the second stock pick. The third pick for ChatGPT is Salesforce, CRM. Salesforce helps businesses manage customer relationships by providing tools to track customer information, such as contact details and purchase history, all in one place. This makes it easier for companies to understand customer needs and improve service. Salesforce also offers features for data analysis and task automation, which can enhance efficiency and decision making. The growth opportunity for Salesforce is high, as the company invests heavily in AI, a fast growing industry. Salesforce is also skilled in making strategic acquisitions, such as Top and Slack, which expands its product portfolio and market reach. With a strong market position, Salesforce has established a solid moat. However, given its size, our rated growth opportunity is 7.5 out of 10. Now, looking at the numbers, Salesforce has a price earnings ratio of 56, driven by heavy investments in growth initiatives like research and development, R&D, and sales and marketing, which lower current earnings. Despite this, Salesforce generates good cash flow with a price to free cash flow ratio of 28, though still somewhat high. The company has a gross margin of 77%, a profit margin of 16%, and a free cash flow margin of 32%, all strong numbers. Its 5-year average return on investment capital is 2.7%, but it's currently at about 8%, which is much better than the 5-year average. Based on the numbers, I would rate Salesforce a 7 out of 10, giving it an overall rating of 7.25 out of 10. Deepseek's third pick is Kraft Heinz. The company, along with its subsidiaries, manufactures and market food and beverage products in the US, Canada, the UK, and internationally. Known for its ketchup, Kraft Heinz can grow by expanding into emerging markets, earning more from already captured markets, innovating new products, and focus on long term strategic planning. However, beyond these factors, there may not be much room for growth, as the company is already large and may face limited profit opportunities. Therefore, I'd rate growth a 4 out of 10. Now, looking at the numbers, Kraft Heinz has a PE ratio of 25 and a price to free cash flow ratio of 11, which is decent compared to the expected future growth. The company has a gross margin of 35%, a profit margin of 5%, and a free cash flow margin of 12%, all solid compared to the sector median. Finally, Kraft Heinz has a 5-year average return on investment capital of 4.3%. Based on these numbers, I'd rate it a 5.5 out of 10, giving Kraft Heinz a total rating of 4.75 out of 10. This gives ChatGPT the third win, with Salesforce rating standing at 7.25. The fourth pick for ChatGPT is General Motors, GM, which designs, builds, and sells vehicles globally. GM's growth lies in expanding driver assistance technologies, especially with its Super Cruise system, which offers hands free driving on over 750,000 miles of North American roads. The company is investing heavily in electric vehicles and autonomous technology, aiming to double revenue by 2030. However, with strong competition from Toyota, Ford, Tesla, and Honda, I'd rate its growth potential a 6.5 out of 10. In terms of numbers, GM has a low price earnings ratio of 7.6 and a price to free cash flow ratio of just 5.1. It has a gross margin of 12%, a profit margin of 3.2%, and a free cash flow margin of 5%, which are decent for the automotive industry. GM's 5-year average return on investment capital is 5%. Based on these numbers, I'd rate GM a 6.5 out of 10, giving it a total rating of 6.5 out of 10. DeepSeek's fourth pick is Equifax, EFX, a company that provides information solutions and business process outsourcing services for businesses, governments, and consumers. Equifax is focused on growing its non mortgage business, which now makes up 80% of its revenue, including services like income verification and fraud detection. The company is also expanding internationally with significant growth in regions like Latin America and Europe. Additionally, Equifax is investing in cloud technology and AI to improve data analytics. However, with high competition, our rated growth potential is 7 out of 10. For the numbers, Equifax has a high price earnings ratio of 60 and a price to free cash flow ratio of 43, meaning its price has outpaced earnings and free cash flow growth. The company has a gross margin of 55%, a profit margin of 10%, and a free cash flow margin of 14%, all decent figures. Its 5-year average return on investment capital is 7.5%, giving its high valuation. I'd rate the numbers a 5 out of 10, bringing its total rating to 6 out of 10. This gives ChatGPT the fourth pick. Finally, we've reached the fifth and final pick, which will decide which bot is the best at finding undervalued stocks. Starting with ChatGPT's pick, Celanese CE, which has fallen 52% in the past year, cutting its market cap in half. Celanese is a company that makes specialty chemicals and materials used in everyday products like phone cases, car parts, and snack packaging. The company can grow through its leading position in the chemical industry and a diverse product portfolio, creating a moat. It also focuses on innovating and expansion into high growth markets such as advanced materials and sustainable solutions. I'd rate its growth opportunity a 6 out of 10. Looking at the numbers, Celanese has a low price to earnings ratio of 7 and a price to free cash flow ratio of 9, which are good. However, the company has seen slow growth in earnings and free cash flow, which may explain the stock's drop. It has a gross margin of 24%, a profit margin of 10%, and a free cash flow margin of 8%, all medium figures. Celanese has a 5-year return on investment capital of 13%, which is solid. I'll give the numbers a 7 out of 10, leading to an overall rating of 6.5 out of 10. The last pick for Deepseek is Devon Energy, DVN, an American oil and gas exploration and production company focusing on extracting energy resources mainly in the US. The company can grow with higher oil and gas prices, government support for energy production, and improved operations and cost cutting measures. Better drilling techniques and exploring new opportunities can also drive growth. However, the sector is only expected to grow with 5%, so Devon must outperform the industry to deliver strong results, which can be challenging. I'd rate its growth potential a 5 out of 10. For the numbers, Devon has a low price earnings ratio of 6.5, but a negative price to free cash flow ratio of 34 due to heavy investments in drilling, developing fields, and upgrading infrastructure. It has a gross margin of 53%, a profit margin of 23%, which is impressive, and a negative free cash flow margin of minus 4.5%. The company's 5-year average return on investment capital is 4.8%. Based on these numbers, I'd rate it a 5 out of 10, giving it a total rating of 5 out of 10, which doesn't beat ChatGPT's last pick, Celanese. To conclude, ChatGPT found the most undervalued stocks, winning with 3 out of 5 picks. The most undervalued stock overall was Google with a 7.5 out of 10 rating. Despite its strong results, Google fell by 10%, so it might be a good time to take a closer look at its stock. Thank you so much for watching. If you want to learn about stocks to keep an eye on in a potential upcoming bear market, watch this video right here.